Hello everyone, this is Carbonomics. COP27 was held in Egypt from November 6th to November 18th, referred to as the Conference of Parties, held every year by the United Nations. And as this channel is about finance, this video will be focused on some of the financial implications of the events that took place at the conference. Well, things like loss and mitigation funding for developing nations were huge themes of the conference. These goals aren't going to impact us as investors in public stock markets. So what happened at COP that will affect investors across the globe? Firstly, it seemed relatively unanimous at the conference that the carbon price needs to rise, and dramatically, to reach, the 2030 and 2050 climate goals. And we had the chief of the International Monetary Fund calling for an average price of a ton of carbon around the world to be around $75 by 2030. There are parts of the world where they already have prices this high, like in the European Union, where a European Union carbon allowance is currently trading for around 79 euros per ton. But most of the world have substantially lower prices, especially the voluntary carbon markets, where credits in the VCMs trade at an average of $5 to $10 per ton. This is going to raise costs substantially for heavy emitting industries as the prices rise. Cement, steel, and other commodity sectors being the hardest hit over the coming decade and beyond because of this. Another blow to heavy emitters, the oil and gas industry especially, is new regulations forming around methane emissions. Specifically in the United States, they're looking to reduce sources of methane emissions 87% below the levels they were at in 2005. Some of the main factors being explored in the proposal are monitoring of all oil and gas well sites for methane leaks, reducing emissions from methane flares, and regulation of technologies like dry seal compressors or pneumatic controllers. So this is another reason that costs will rise for any player in the oil and gas space that wasn't already focused on lowering these emissions. But ultimately, further regulation like this was to be expected. The Western world is raising the costs of oil and gas production as much as possible to incentivize the switch to renewable energy sources. The main problem being oil and gas derivatives are used in so many household and industrial applications, which is why the world is suffering from an energy crisis right now. So there is a fine balancing act between the future of the planet and our needs as citizens, especially in the developed world that consumes a lot more oil and gas. Another theme of the conference was increased regulation of markets and how climate risks are reported by companies. Global regulators are now getting involved, especially in the carbon credit markets. The International Organization of Securities Commissions, the IOSCO, has been making recommendations for the improvement of compliance carbon markets and looking into ways to further regulate the voluntary markets as well. Their goals were to deepen liquidity in these markets and prevent greenwashing, which further regulation would certainly do. One of the primary issues the carbon markets have faced up to this point has been, this view of them being the Wild West or unproven. Many asset managers that would buy carbon credits or emitters that would use them to offset emissions have been holding off because they feel that the markets are relatively untrustworthy. There are still questions surrounding how a credit's verified and if many of them are genuinely contributing to the global goals of reducing emissions. With federal regulators like the Security and Exchange Commission, the SEC, and the Commodity Futures Trading Commission, the CFTC, in the US stepping in, and now even global regulators like the IOSCO entering as well. The markets will quickly gain credibility in my view. Combine that with regulators stepping in and forcing companies to disclose their climate risks or associated emissions, and there will be even further incentive to start participating in these carbon markets. Continuing the lines of enforcing disclosures, the European Central Bank is forcing all banks under their regulatory authority to include climate and environmental risks in their risk management criteria by the end of 2023. In addition to that, supervisory expectations set by the ECB about identifying climate risks will need to be met by 2024. So regulation is only on the rise, and it will be increasingly difficult to justify how your company isn't doing anything about these risks as we move into the next decade, especially. And this is now creating financial incentive as well, because banks that fail to comply might be forced to hold more reserve capital, for example, to account for the additional risks associated with the climate. Another issue that's currently being addressed is how carbon credits are traded. As the markets currently operate, most of the carbon credits in voluntary markets are being exchanged over the counter, meaning there's no real direct exchanges these trades are being placed on. And this creates both illiquidity and a lack of price discovery in these markets, since there's no standardized contract or price to compare to. Well, Bloomberg and the Three Cairns Group have revealed a plan to help on this front, and the two are forming the Global Carbon Trust, which will be driven to focus on two areas. Technically three they set out here, but I've shortened it down to two. One being creating fungible, standardized contracts to help trade carbon credits, and the second to increase the supply or availability of carbon credits. And this will be especially important for developing countries that don't have the infrastructure or funding necessary to create their own carbon markets. And there are other companies that are already engaged in this task as well, working to create easily tradable credits, as well as companies minting them into NFTs. But the Global Carbon Trust will be another one of these players in the growing carbon markets, and any additional help in creating credibility is definitely beneficial. An interesting outcome of this conference is that we might start seeing the formation of an international carbon market. We have several nations that have already started working on the ability to trade credits between nations. We had Ghana, Switzerland, and Vanuatu forming the first ever cooperation under Article 6.2. So this is kind of opening the door for larger coordination between countries on reducing emissions. But we'll have to continue following how this evolves as we move into the next year, especially, and towards COP28. Lastly, we had John Kerry announcing the United States plan to create carbon markets explicitly designed to incentivize the development of renewable projects and to shut down existing coal power plants. The plan is to have the new markets up and running by the time the next COP rolls around in 1 year. But what this really means for investors, if the markets are successful, this means even more demand for energy transition metals like copper, cobalt, and more rare metals. By contrast, lower demand for coal, obviously. In the event there's a significant amount of coal power plants retired because of this initiative especially. But most of the events occurring at the conference will obviously affect commodity and energy markets the most, as those are the most polluting industries. But really, in closing, as regulation surrounding the carbon markets continues to get fleshed out and the markets are more proven, the more companies around the world will end up buying credits to offset their emissions, especially as financial regulators are looking to force companies in the West to disclose their climate risks and deal with associated emissions as well. But this is going to be the end of the video here. If you liked it, please remember to like and comment on the video and subscribe to the channel. Thanks for watching.